In this video, I'm gonna lay out all the benefits to owning rental property, reveal how much cash it takes to close your first deal, and share my personal experience investing in real estate with hardly any money. Now, you might be a lot closer to your first rental property than you think, so let's throw it back over to the studio and I'll show you. Hey everybody, and welcome back. If we haven't met yet, my name is Daniel, and my wife and I have invested in real estate for the past 2.5 years, acquiring 3 rental properties in that time period. I'm also a financial manager for one of the largest companies in the world, and I serve Northwest Arkansas as a licensed real estate agent. For those of you who have been following along, this is episode 2 in our initial 10-part series that covers the basics on everything to do with real estate investing and making winning financial decisions. Last video, we took a look at how to renovate a rental property, all the expenses associated with it, and how to do quality work on a budget. Today, we're gonna take a step back and look at exactly how much cash you need to bring to the table to buy your first rental property and the financing options you have available. And if you hang to the end of the video, I'll reveal exactly how much cash I brought to the table to acquire my first duplex. A good place to start is to ask ourselves, why real estate in the first place? Why not stocks, bonds, gold, silver, cryptocurrencies, or another asset class? Now, while all of those definitely have a place at some point in your investing career, real estate has some unique advantages. The 4 main benefits of owning real estate include cash flow, principal paydown, appreciation, and tax and depreciation benefits. Cash flow is the amount of money that you make on a rental after all the expenses are covered. So for example, say you rent out your property for $1,800, you have a $900 mortgage and $400 for expenses. You take the $1,800 minus your mortgage, minus your expenses, and you're left with $500 of free cash flow. Now, cash flow is definitely important, and especially when you're starting off, but appreciation, that's where you're gonna see that massive wealth increase over time. Appreciation is the increase in monetary value of your asset. Now, this could be due to renovations, a new development being built near you, location, inflation, or just simple changes in the market. So as more money is printed into the economy and the US dollar is devalued, that's when you see real asset classes such as real estate increase in value. Now, principal paydown, it's a lot less flashy, but over the long term can have a massive impact on your wealth accumulation and growth. So a financial institution will front load the payback schedule for a mortgage, meaning you pay a majority of the interest up front. However, every month you do pay a portion of the principal, which means you're gaining more equity in the property. And what's amazing about real estate is in the end, you're not even paying that mortgage. Your tenant is. Tax benefits. Now, definitely consult a licensed CPA who has experience and knowledge working with real estate investors. But in short, depreciation and tax benefits are one of the best ways to offset rental property income. If you all would like me to make a specific video, I can show you how I paid no tax in 2019 and 2020 on my rental properties, utilizing depreciation and specifically the cost segregation strategy. So now we know why real estate is a viable investment. Let's talk about the financing options and how much cash you're gonna need to bring to the table to close your first rental property. Now, sure, you can definitely pay cash for a property, but who has $250,000 just sitting around? So there's 3 major ways to finance a rental property. There's your traditional commercial financing, there's owner or seller financing, and then owner occupied financing. So let's explore these 3. First, traditional commercial financing. This route is used the majority of the time by investors buying a property. It's fairly simple. Lenders will often finance up to 80% of the property's purchase price or appraisal, whichever one's lower. Thus, you bring 20% to the table at closing. So if we look at a $250,000 house, 80% of $250,000 is $200,000, leaving you with 20% or $50,000 to the table, plus closing costs and other fees. Second is owner financing. Now, this is the most rare form, but it can be very beneficial in certain cases. Let's start with an example. So say you run across that same $250,000 house and the owner owns it free and clear. Instead of going the traditional route and going to the bank, getting approved and getting a loan, you as the buyer would pay the seller your mortgage payment over a set period of time with a set interest rate until the property is paid off or refinanced. There are pros and cons to this strategy, and it definitely has to be a unique situation. But for an older investor getting out of the real estate game, it might be ideal. The advantage to the seller is that he's collecting passive income every month and no longer has to worry about the repairs, management, or upkeep. It can also be a great way to spread out capital gains instead of being hit with a massive tax bill at one time. And finally, the advantage to the seller is he has first rights to repossession if you fail to make your mortgage payment. So you might be wondering, how does this benefit you or I? So there's a few reasons, but first off, the initial cash outlay can be much less. Instead of coming to the table with your traditional 20% down or $50,000 in this case, it could be negotiable. You can work with the seller and bring less money up front for, say, a higher interest rate. Dealing directly with an owner can be advantageous for new investors. That's actually how I bought my first rental property. The bank wouldn't loan to me as a 20-year-old because I didn't have 2 good solid years of tax returns. I had limited cash reserves and no consistent income at the time. So instead of pouting, sitting on the couch and watching Dancing with the Stars, as Brandon Turner would say, I found an owner that would take me on as a risk because he knew me as a person as opposed to just an applicant number in a banking algorithm. So you might be thinking, Daniel, the first example seems like a lot of money. The second one seems rare, and you're right. But the third example is the owner-occupied financing, which is my personal favorite and a very low barrier to entry. So owner-occupied financing is exactly what it sounds like. A bank will give you favorable terms if you physically live in the property for at least 1 year. So if you buy a house for $250,000 and utilize owner-occupied financing and have the intention of living there for at least a year, your down payment could be as low as 3.5% or $8,750 in this case. Like I said, you'd have to live in that property for at least a year, but after that point, you could move and keep that owner-occupied financing in place, rent it out, and go do it again. Let's say now you rent out your house for $1,800 a month. Your mortgage payment's gonna be about $1,000 on a buy price of $250 at an attractive owner-occupied interest rate, and your expense is about $400. So after it's all said and done, you're cash flowing $400 free and clear. Now this method of acquiring rentals is a sacrifice. You have to move a lot and it's relatively slow, but you could easily acquire 5 rental properties in the next 5 years, which would total $2,000 of cash flow free and clear. Now, if you do the math on that, that's $24,000 every year of passive income that's essentially tax-free if you depreciate it properly. So pre-tax, that's like making an additional salary of $30,000 every single year. Now the scenario we just ran was with a single family house. So if you did the same thing with a duplex, triplex, or fourplex, you could be looking at exponential results. Owner-occupied financing generally has the same terms for a property with 1 to 4 attached dwelling units. So let's play out the scenario doing the same thing with a duplex. Let's say you buy it for $250,000, you live in one side and rent out the other, and do the classic bigger pockets house hack. Your mortgage would still be about $1,000 a month, but you get to collect rent from the other side. Let's say $1,200. You have essentially reduced your living expenses to zero, while still getting the benefit of appreciation, principal pay down, and all of those tax benefits. Now, the real magic happens when you move out. So now you're collecting $2,400 in monthly rent. Your mortgage payment is still $1,000, take out $400 for expense, and you're left with $1,000 a month, free and clear cash flow. If you take action and do that 5 times in 5 years, that gives you $5,000 of passive income free and clear, times 12 months gives you $60,000 of free cash flow every single year moving forward, while still benefiting from the tax benefits, the principal pay down, and the appreciation. And in the time period since you bought those properties, it's very likely that the duplexes might be worth $300,000 now, as opposed to the $250,000 you paid. So that would be a $50,000 equity gain on 5 duplexes, which is $250,000 that goes straight to your net worth without essentially doing anything. So just by moving every year for 5 years, you've added $250,000 to your net worth. So with $60,000 of passive income every year and at least a $250,000 net worth, that alone would allow you to retire from a job you dislike and pursue what you're really passionate about. Now, let me just interject and say I am not a hater of the W-2 9-to-5 job. For me, it's provided a ton of opportunity to grow and develop. However, if you ever do want to exit your job, having real estate that provides income does allow you to have that option. So in short, if done correctly, real estate can provide you time freedom so that you can live more by design than default. I want you guys to know that all the content I'm communicating in my videos, I have tested first to see if it works. So let me give you some real examples of the duplex that I bought with a 3.5% FHA loan. If you watch my remodel video, you saw that I bought the duplex for $190,000. I put $20,000 into it in remodel, bringing my total to an all-in $210,000. It recently appraised for $250,000, giving me a bump in equity of $40,000. As I mentioned earlier, I bought the duplex with an FHA 3.5%. FHA stands for Federal Housing Administration and is often known as providing first-time homebuyer loans. So if we take 3.5% of the $190,000, that leaves us with $6,650. On top of that, I negotiated $5,000 in a closing cost credit. It only cost about $3,000 to close, so I was credited the remaining of that balance, which brought my total down to $4,928.90. I was also credited prorated rents for the last 10 days of the month, which came out to $400. That brought my out-of-pocket total down to $4,528. But wait, it gets crazier. So just a week later, it was the first of the month. So I collected $1,200 in gross rent from the existing tenants. Now, under FHA guideline, you have 60 days to own or occupy the property, so I took advantage of this. After another 30 days, I collected another $1,200, and at that point, one tenant decided to vacate, so I owner occupied that side, which is the side you saw remodeled. So if we take that $2,400 I collected in the first 2 months of rent and subtract that from our out-of-pocket cost at closing, that brings our total down to $2,128. $2,128 to buy a duplex. Isn't that crazy? You might be thinking, with such low money down, that's probably an astronomical payment. Well, not really. Even after PMI and escrowing in taxes and insurance, my payment's only $1,200 a month. And keep in mind, I'm still collecting rent from the other side. Now, that doesn't quite offset the $1,200, but it's close, so I'm netting about $400 for my living expense. So I'm only paying $400 a month to control a $250,000 asset that produces $9,000 a year, while I still get all of the tax benefits, the appreciation, and the principal pay down. Do not forget that real estate will not make you wealthy overnight. However, taking action now will lead to significant wealth accumulation and time freedom. Instead, I like the saying, real estate will make you rich overnight after 30 years. If you have further questions, drop them below in the comments and I'll respond to every single one. If you disagreed with the strategy I used, let me know which one and why. As you can see, I definitely love talking about real estate and I'm happy to keep the dialogue going. If you have specific questions about getting into your first rental, feel free to DM me on Instagram and I'm happy to dive into your specific situation. Don't forget, it is a great day to be alive and I'll see you in the next one.